Hello, this is Professor Hazer again, and this is I would say, about fourth video on business combinations. And this is the first example that I'm going to give you on a business combination in which there's no liquidation. Okay, and I'm just going to go back very quickly to the PowerPoints here. And PowerPoints, in situations where there's no liquidation, what you have is you have company A buys all the stock of company B. You end up with two companies, but one company controls the other one. So as shown by the green box there, you have, in effect, in substance, one company, but in form, legally, you have two different companies. One just happens to control the other one. So from a financial accounting perspective, you have to put their financial statements together. Okay, and then I'm going to go down to this slide here. I'm being a little informal about this, but this slide here, we have three situations. First one was liquidation with goodwill, so you overpay, you pay more for something and the asset is liquidated. Next one is liquidation with bargain purchase option, which means that you do away with all the assets, you do away with the other company, bring over all the assets and liabilities, but you pay less. Then we're going to have two situations where we have no liquidation. So we're going to have two situations that look like this. First one with goodwill, you pay a lot. Second one with bargain purchase option, you get a bargain. You don't pay that much. You pay less than the net book value of the fair value of the other company. Okay, so let's go ahead and start the Excel worksheet here. And let's see where we're going to start here. Okay, and this is the worksheet which I'm going to be doing, and I hope that I have enough time for this, and I will have to do it again. But I just want to point out one thing, that this worksheet, compare the combination with no liquidation with goodwill with the combination with liquidation with goodwill. And I want you to notice that they're basically the same. We're going to have the same purchase price, same expenses, same financial statements, and we're going to compute the same goodwill. The big difference is going to come in that the parent is going to buy the stock, record the expenses, but not liquidate. So we're not going to have a liquidation entry on the books of P. What we're going to have is what we call a consolidation entry on a separate worksheet, which puts the two sets of financial statements together. Okay, so let's start the process here. Okay, let's compute the cost again. Hopefully I'm going to have time for this. If not, I'm going to have to do something to cut it short. The cost of this is 33,000 shares at $25 per share. Okay, so we'll put the cost right here. It's 33,000 shares at $25 per share. So the cost is going to be 33,000 times 25. 825,000 will be the cost. Those are dollars right here. Okay. Then we're going to compare that against the net book value of the other company, which is what we've always done. So we're paying $825 for 300,000 in common stock, 50,000 in additional paid capital, and 170,000 for in retained earnings. Okay, so we're going to compare the two as usual. So we're paying $825 for a company with a net book value of $520. So add the two together. You're going to get 305,000 is your difference, and I should line this up. I should move the whole thing down to here. Okay, then we're going to take all the separate assets and liabilities like we've been doing. I'm being repetitive here, and it takes up a little time. You've got to see this process. And we're just going to subtract the fair values from the book value. So the fair value of accounts receivable is 40,000. The book value is 30,000. And to save time, I'm going to go ahead and see if I can save some time here, end this space, and cut this short down to here. And so the last line should be equipment's 250 versus 200. Unfortunately, that was turned around. I'll erase, I guess, and start over again. Okay, so the fair values of accounts receivable is 40,000. So I should be able to copy down. And so the fair values are all there, 40, 120, 150, 300, and 250. And the book value of accounts receivable is 30,000. So I should be able to copy down from here. Okay. I think those are off. Oh, I'm taking cash. Let's do this. So sorry. I want to save this space. I'm using it all. Okay. So that's what happened. Okay, then the fair value of note payable. I'm not doing accounts payable because they're both the same. Make a difference anyway. We've got fair value minus book value. Okay, so keep in mind the rules. If the fair value for an asset is less, then you add the difference. If fair value is greater, subtract the difference. Liabilities, they're the opposite. Okay, so we're going to, for this one, if we just do this, negative 40 minus 50, we add the difference for, because the fair value is less than the book value, and we're going to copy this down to here. Can't apply that formula to a liability because it's different. For the liability, if the fair value is less, then you subtract the difference, which is less than for an asset. So we'll just take the difference here, which is negative. Okay, so that should give us the correct answer. And this 305 should not be underlined. Underlined should be right there. Anyway, if I did this right, our goodwill should be exactly the same as before, 155. So we got $155,000 of goodwill, and I can take the liberty to do a few things inefficiently because you've already seen this. That's the same goodwill that we had before. Now, the other that we had on the combination with liquidation and goodwill. Okay, now the purchase price is exactly the same in this case. So we're going to go ahead and on P's books, these are entries both on P's books, we're going to debit the investment account. You always debit the investment account for the cost of the asset. Okay, and then for common stock, we know that we issued common stock worth, the shares we issued were 33,000 shares with a par value of 10. That should be shares, by the way. That's changed around. But anyway, so we're going to credit common stock for 330,000. That's 333,000 times 10. 330,000. And the difference is the investment less that. So that's the correct entry. Okay, these are shares, not dollars. We'll have to get back to that. Okay, in our expenses, we know our expenses. We're going to debit expenses for whatever our expenses are. Okay, so our total expenses were 140,000, and we paid cash of 140,000. Okay, so those are the two things that P has to do. They have to record the investment in stock. They bought stock. That's the first thing they do, the purchase of stock. And so it's $825,000 for the stock. They have to record their expenses. Now, what P cannot do is it's not liquidating the other company. So what P cannot do is record a liquidation entry on its own books. So what we're going to have to do is we're going to have to go ahead and record the two entries that P actually does make, the investment and the expense entry. And then we're going to have to do something called a consolidation. And I'll telegraph a little bit. What we're going to do is we're going to revise P's books, and then rather than do a entry on P's books to bring over all the net assets and liabilities and liquidate the other firm, what we've got to do, since we have two firms, is we've got to combine their books, and you'll see that the results are the same. Okay, so let's go ahead and just P has to record the investment and the costs. The investment is, this is journal entry 1. Then we're going to do journal entry 1 again, common stock, and journal entry 1 here. Okay, so journal entry 1 has a debit to the investment account equal to $825,000. And then there's a credit on P's books for $330 for common stock and $495 for additional paid in capital. Okay, and then we're going to go ahead and I'll call it entry 2, and we'll put cash up here, entry 2. That's entry 2, not 1. Okay, and in entry 2, we're just going to go ahead and close the expenses to retained earnings, because all expenses and revenues are closed to retained earnings. And so we're going to have, put that as a negative, debit expenses for 140, and we're going to credit cash for 140 from this entry here. So we've got 2 entries. So P so far on its own books has recorded an investment and recorded some expenses. Now we're going to have to come over, and what we're going to do is these entries were all made on the parent's books. It cannot make a liquidation entry and come up with one big company because it's not liquidating their company. So rather than liquidate the company, what we're going to have to do is consolidate their company. So rather than do a big entry and bring over all the net assets, what we're going to do is take this 2 sets of books and put them together. Okay, so let's first of all record the results of P's transactions here. Okay, so cash is 150 minus 140, which gives you the 10. That number hasn't changed. That number hasn't changed. That number hasn't changed. Equipment has not changed. Investment has changed. Investment is 825 now. Goodwill, I've got goodwill in there, and we're going to need a goodwill column here. Goodwill for now is 0. So let's just sum these up and see what we get. So P's balance sheet is now 3485. Now accounts payable has not changed. Notes payable has not changed. Capital stock is 800,000 plus 330. So capital stock is now 1130, and additional paid in capital is 600,000 plus the extra 495 that P recorded, and retained earnings is actually 500,000 minus 140. You got to know your debits and credits, folks. So that's going to give us a sum for P of 3485. So we're good here. Okay, so that's P's balance sheet after having the that's P's balance sheet after making the investment and expense entries. Now what we've got to do is take Seabird's, bring Seabird's financial statements down. We'll probably just copy them, and then what we're going to have to do is make an entry which makes some which adjusts all of Seabird's assets and net liabilities to their fair market values, and combine the financial statements. Okay, so let's go ahead and go up and just copy Seabird's financial statements. You've got to start learning how to do this. We're going to copy the book value of the financial statements over. Okay, so let's start with the assets. We'll copy these down to here, and we will push 760 down to there. Okay, so that, because that's the total. So that's their total assets. Okay, let's do the other side of the balance sheet. Let's do the other side of the balance sheet here. The other side of the balance sheet are these accounts here. And we're going to go ahead and copy those all the way here. And make sure I have everything correct here. 760 looks good. Okay, and I'll go ahead to get my little setup here going. That's a consolidation. I want to see if I can't. I'll probably regret this, but border. The border there. Okay, now what we've got to do to finish this process is we know that P did not, they own stock, and that stock is reflected in this investment account right here. But what we're going to have to do is the same basic process, but the mechanics are different. We're going to make a consolidation entry. We're going to actually make an entry on this consolidation worksheet here, which is not part of P's accounting system. But what we're going to do is combine the books, take these P's books, go put them with asset books, make an entry which kind of looks like a liquidation entry, and put the statements together. And that would be the statements for P&L. Okay, so I'm going to call this entry C1 because it's consolidation entry number 1. And what we're going to do, so we'll just call this entry C1, consolidation entry number 1. And what we're going to do is we're going to bring over all of P's assets over at their fair market values. And what we're going to do is we're going to be using this calculation, the goodwill calculation right here. Because what we're going to do is the entry is going to be, we're going to eliminate P's equity, we're going to eliminate S's equity, and bring over not the total fair values, but the adjustments to fair market values of these various assets and liabilities. Okay, so the basis for this entry really is going to be these three numbers here, because you own it, you're going to throw it away, the equity away. We're going to eliminate the investment account and then bring over the adjustments. Okay, so here's what we're going to do. We're going to debit common stock. We're going to debit additional paid in capital. And we're going to debit retained earnings. Okay, and we're going to do those for the amounts. We're going to do those for the amounts that are buried in this 825. So we're going to debit common stock for $300,000. We're going to debit retained earnings or additional paid in capital for $50,000. And we're going to debit retained earnings for $170,000. And the reason we're doing that is because we're throwing the stock, we're throwing all the equity in the garbage, and we're going to throw the investment account in the garbage too, and replace it by combining the actual statements. Okay, then what we're going to do is, using the same calculation, we are going to bring over the adjustments, not every asset in this case, but we're going to actually make these adjustments in this entry right here. So, and be careful, because keep in mind that this is a write down of an asset here. So these adjustments are going to be in the opposite direction of what they're shown out in this calculation. So we're going to write accounts receivable down, because look at the fair market value is actually less, and all these negatives are actually write-ups in a sense. Okay, so I'm going to go ahead and write in these accounts here. We have accounts receivable. We're going to have, and I'm going to take them from, I'll just show you where I'm getting these from. I'm getting these from this calculation right here. We're going to have inventories. It's going to be a very informal journal entry. We're going to have land. We're going to have buildings, equipment, note payable. We're going to have buildings. We're going to have equipment. We're going to have note payable. We're actually going to put in here also the goodwill. We're going to put the goodwill in here. And then we're actually going to, and we're going to credit the investment account. And what we're doing is, the investment account is equal to, in this calculation for 825, it includes these three items right here, and all these adjustments here, and the goodwill. So that's where we're playing around with here. And you'll see why we have to make the adjustments for the accounts and not for the fair market value adjustments, not for the total account amounts like before. Okay, so this is going to be, for accounts receivable, all these are going to be, you have to reverse most of these things. We actually wrote accounts receivable down, by the way, by 10,000. So we're going to credit accounts receivable for 10,000. So we're going to have a credit to accounts receivable, and I just shouldn't put a negative there. That's the absolute value, for 10,000. Now, inventories is going to be, now I should put negatives in here. Negative I'm going to debit inventory. It's really right up. It's fair value is 120, book value is 10, so it's really right up. So that's why I'm debiting it. Okay, and then we're going to debit land for 50, and then we're going to debit buildings for 100,000. Equipment, I believe, was a write down. So we're going to credit equipment for 50,000. Note payable was a write down of a liability, which means you're going to debit the liability. Liabilities go down. It was a write down of a liability, 180 versus 20. So we're going to put 20 into there. We're going to take out the absolute value of that thing. Okay, and if we add this entry up, we're going to end up, I want to make sure we're going to add here, with 730 on one side and with 60,000 on the other. What we're going to go ahead and wipe off the investment account. The investment account, we're going to make that 0 on the books here. That's 885 we have on one side. So that's 885. What we need is, the only thing that we're missing is goodwill, which is going to be an asset account. So we're going to have 155 in goodwill. I should not have put that in the negative. Okay, so we've got 885 on both sides. So we're going to make it in this entry in this consolidation worksheet. And you're going to see that the results are the same as the liquidation entry. Okay, and just to save time, because I'm running out of disk space, the reference for all these, I always like to reference things, but the reference for all these entries is this entry C1 here. Okay, so we don't have any entry to cash, but we have an entry to accounts receivable. Let's start with the first entry. The first entry was actually the first 3 debits. First of all, you had a debit to capital stock. A debit to capital stock. I'm just going to work down the entry for 300,000. Then we have a debit to additional paid in capital for 50,000. Then we have a debit to retained earnings for 170. Okay, and these are all consolidation entries. So we've gotten rid of the first 3. And those get rid of, and it's C1, all your refs here are C1. And those basically are saying that you're, in a sense, you're getting rid of your equity. Even though the other company continues to exist, from a consolidated perspective, you're only one company. In a sense, you're kind of looking at yourselves as one company, even though in reality you're not. Okay, so the next adjustment we're going to have is a credit to accounts receivable. Credit to accounts receivable right there for 10. And then we're going to have a debit to inventories for 40. Debit to land for 50. A debit to buildings for 100. A credit to equipment for 50. That takes care of all the asset adjustments. Okay, then to accounts payable. We don't have any to accounts payable, but I think we have a debit to notes payable for 20,000. We have a debit to notes payable for 20,000. And then 2 important credits. One important credit is to the investment account. The investment account is credited for 825. What you're doing is throwing your investment away and replacing it with the actual financial statements in total. But since we're only using the adjustments to fair value because we already have the book value. So if you take the book value plus the fair value, you'll get the new fair value. Okay, so let's see now. Our final amount is to notes payable. Our final amount is actually to goodwill. We created goodwill through this entry, so 155. Okay, so I'm going to go ahead, and I'm rushing through here because I've limited disk space here. We're going to add these 2 together. So the combined entities have cash of 40. This is going to be book value plus debit minus credit. So the new amount for accounts receivable is 270. Okay, then we go down here. I'm going to go ahead and sum these up and see what I get, because I'm just taking 2 balances plus debits and credits for assets, plus debits minus credits. So 4270, 640, 550, 1300, 750. The investment account should always be zero because you'd be double counting if you didn't. You're replacing this investment account with the actual assets and liabilities is what you're doing here. Okay, and so we're going to go ahead and got 155 of goodwill. So we're going to sum these up here. Sum these up. And your new balance is 3705. Okay, and then we've got liabilities and shareholders' equity. Liabilities are going to be P's liabilities plus S's liabilities minus the debits plus the credits. The credits, which is zero in any case. So your new notes payable, your new accounts, your accounts payable is the same. Let's see if we can kind of just copy the rest down here. Okay, so you got 780 there, 1130, 1095, and 360 equal to sum. And the sum, they equal 3705. So those are the consolidated financial statements. Now, the first time you do this, and they get more complicated, but the first time you do it, it's a very simple consolidation, the same. But look at one thing. I want you to look at one thing, and we can actually maybe or freeze the panes here. Freeze the panes here, and if we do freeze the panes there, what you're going to see, those are your consolidated financial statements. What you've done is you've taken two sets of financial statements. You've adjusted one. P had to, first of all, on its own books, record its own investment and the expenses, and to come to these new financial statements here. And then you took S's financial statements, and what you did basically is you made the investment zero, which P had bought way over here. You made that zero on the consolidation, and you replaced that 825 with all the write-ups. And if you take all these write-ups and write-downs to fair value, you're in essence taking the book value and making the adjustment, so you end up with a new fair value. You made that zero. You recorded your goodwill. It was originally zero. You recorded for 155, and you did the same thing for the liabilities. Now you're eliminating all you're limiting all the equity accounts because you'll notice that the equity accounts are all equal to P's equity accounts because the value of the equity accounts was part of that 825. If you had left them in there, you would have double counted. But I want you to compare what's in the square here. You get the same totals. You get the same totals there. You should get the approximate same financial statements as we did in the over here. And you'll notice that we do, in fact, end up with 3075. So it's the same thing. It's a little more complex, but when you liquidate, the parent makes this entry and brings over the total assets, the total amount for each asset and liability. And then it just merges itself into one company, but you get 3705. Notice it's only one company here. In a consolidation, the final company is two companies, but you've combined the financial statements. Now, the major difference is that you've taken the parent's book values and the sub's book values, but since you took the sub's book values, you don't need to add the entire fair value in. You just need to put in the write-downs and write-ups, the fair market value, and those will give you the same numbers. Just compare. You got 4270, 4270, 645.50. Just make a comparison. 4270, 645, 50, 1300. They're the exact same numbers. They're the exact same numbers. And the reason is, here we're adding all the numbers because we're bringing over the entire asset. Here we have two companies, one with book values, and if we take the book values and add the fair market value adjustment, we end up with fair market values. In essence, the consolidation takes the place of the liquidation entry. Okay, I'm going to stop there and upload this one, and we'll do this one a little more slowly, I believe, for the